I want to address a paper I saw this morning that was also picked up on a Yahoo and other news distribution sites about a call for the CFPB, the Consumer Financial Protection Bureau, to take on the role of consumer reporting agencies, the role that they're filling now in gathering and distributing consumer information related to credit in order for lenders to decide how and when to lend money. Here's the problem, and we can acknowledge this. There have been inequalities in the past in the system of personal finance in this country. That's clear. It should not be an argument at all. We know of redlining. We know that there are banking policies that have been in place over the centuries, last century and a half, that would directly affect not just low income, but specifically race-based communities of color. So that's a problem. The solution, proposed solution, is to allow the government to create the equality through the credit reporting system. So it's not the government solution that I would have a problem with, that we might have a problem with if we look down the road and how this what might come of it. In fact, most people that I talk to in my courses that I do, the thousands of courses I do over the last 5-10 years, they think that the consumer reporting agencies, or credit bureaus as they're known, are already government agencies. They hear the word bureau and just assume. The problem is this: by moving the consumer reporting program system to a government and allowing the government to do something with that, it's treating a symptom, not the underlying problem. It's not that consumer reporting agencies aren't important and are just a band-aid on the problem. They have an important role to play, and they can and are actually developing some programs to address some of these problems. Inequalities exist in the policies, still in policies of the credit system, not necessarily in the consumer reporting gathering and distribution, but in the system, and more importantly, at the individual level and at the business level for lenders, where the individual can make biased decisions. But collecting information right now and distributing it, the information itself is just data. It's not race-based data. That's been prohibited for decades. Here's the thing. Consumer reporting agencies, CRAs, also known as credit bureaus, they report past credit-related activities so that the lenders can try to predict future credit-related activities. Past related activities, especially recent past. That's why they don't include anything over 7 years old, except things like bankruptcy, because it becomes unreliable. And that's also why information that is just a year or two old has a greater impact on our credit rating than information that's 5 or 6 years old. The entire purpose of consumer reporting is to help predict, should be to help predict future behavior when it comes to paying debts on time. The credit reporting agencies and the credit scoring providers, FICO and VantageScore, but FICO particularly, have begun to develop alternative credit products that rely on data that is not just related to borrowing. Because of the system that we've been in, many communities of color have been disadvantaged when it comes to borrowing. So obviously what they have on their individual reports, is going to be a reflection of some of that problem. So the alternative reporting information relies on things like bank accounts and on paying utilities and on paying for cell phones and things like that, which is going to help. It is not industry-wide yet. That should be more of a focus right now, I believe, than trying to just toss out the entire system and hand it over to the government. We do need to revisit the use of credit. This is one thing that I do agree on in many cases, because it is not just used for credit-related information, credit-related decisions like borrowing money. It is now a fundamental factor in determining car insurance and homeowners insurance and renters insurance and personal life insurance policy premiums. Yes, there can be a connection, and there are studies that show, crazy as it may seem, that as a group, people with lower credit scores get into more accidents and file more claims than people with higher credit scores. That doesn't mean that you have a high credit score, you're a great driver, or if you had a bad credit score, you're a bad driver. That's how insurance works generally, though. So we have to understand it's not just credit that is unfair, because you could be a male, 22 years old, single, drive a sports car, and be an excellent driver. Statistics show that you're probably not, but individually you can be. Anyway, so that's one thing, is the role of credit in insurance premiums. That one is tenuous. There is some reports. I've seen only 2, and they are now almost 20 years old, back from the early 2000s. What about employment, though? Here's where it gets really, really tenuous. It's hard to justify this, but I can understand the justification, but there's better ways around this. Credit score is not part of the employment or hiring process. Credit score, it is illegal for a lender to look at your credit score, but what they do look at, and often, is when they pull your background, do a background check. Many of those background services include a check of your credit history. And they do so with the justification that, hey, if somebody has a lot of collections on their account, they're going to be spending a lot of time at work dealing with personal finance things. We're not going to get into whether or not that is true or justifiable. But including your credit check, or including a credit history in your background check for employment, absolutely can hurt excellent workers that have struggled with credit. So that one is something that instead of just throwing out the whole system, might be something to focus on instead, as well as housing. Now, it does make sense for a landlord or a prospective property management company to assume that if somebody has been paying their bills on time and has excellent credit, that they've been paying their debts as agreed, that they will pay their rent as agreed. And in fact, that is one of the factors of the alternative credit reporting systems products that are being developed, is they look at, are you paying your rent on time? If you are, then you should probably are going to be less of a risk at missing payments on your credit in the future. But it does tend to harm those who have no credit history or have poor credit history. There are other alternatives than just throwing out the whole credit reporting system. To develop a renter, why not develop a renter's reporting system or a landlord reporting system, which in many cases I'm sure there already are. Lenders, the last point, this paper notes that the customers of the consumer reporting agencies are not consumers, but are lenders. And they say that as if that's a problem or some big new revelation. It is true, and it's not a problem. The problem is with us as a society, we've come to believe that our credit scores are personal issues, that they are personal representations of our personal responsibility or our reputation, and they are not. Your credit rating, your credit score, is simply a statistical prediction based on past behavior of potential future behavior. That's all it is. It's not, are you a good person, bad person? How are you trying to pay your bills or not trying? Are you irresponsible? No. It is just trying to predict for lenders who are trying to decide, hey, is this person a good risk or a bad risk? Lenders, I mean, what's next? Are we going to transfer all of the lending responsibilities in this country to the CFPB, which, by the way, I think the CFPB does a great job with a lot of their services and products. But if we're going to turn everything over to a public entity, lending would be next. They have, I mean, we do have it in already directly in student loans. We have it indirectly in many mortgages. Is that the direction we want to go for personal loans and car loans and every other kind of loan? Because privatized lenders need to rely on, they need to make money. They need to break even at least. They can't lose money every time they lend money. So they are going to use the best system they know, the most efficient system they know, which is the consumer reporting system and credit scores, to help decide, is this person likely to pay as agreed? Are there tweaks that should happen? Yeah, I'm sure there are, and there will be, and there have been. But as we strive to clean up the role of the consumer reporting agencies and credit scores in the process of creating more equity in our country, let's make sure we are not throwing the baby out with the bathwater.